40.23. That's the Shiller PE ratio right now. January 2026. In 140 years of market history, it has only been higher once. Right before the dot-com crash erased nearly 80% of the Nasdaq and destroyed trillions in paper wealth. And here's what should genuinely unsettle you. The conditions forming in 2026 aren't just similar to 2008. They're worse. Because in 2008, the system was hit by one primary failure housing. In 2026, we're staring at 4 structural crises converging at the same time. And once you see how they connect, you'll understand why this isn't fear-mongering. It's arithmetic. First, let's deal with the illusion of safety. Most economists say there's nothing to worry about. The OECD forecasts 1.4% growth. Morgan Stanley expects moderate expansion. JP Morgan puts recession odds at just 35%. Comforting, right? These are the same institutions that said subprime was contained in 2007. The same experts who claimed the new economy had eliminated recessions in 2000. The same forecasting models that fail at every major turning point because they don't account for what happens when multiple systems fail simultaneously. Their models assume stress happens in isolation. Reality doesn't. Let me show you the first fracture. Crisis 1. Commercial real estate $936 billion. That's how much commercial real estate debt matures in 2026 alone. Add the $525 billion that rolled in 2025, and you're relooking at nearly $1.5 trillion that must be refinanced at interest rates roughly double what borrowers originally paid. Here's the math that breaks the system. A building financed in 2021 at 3% now needs refinancing at 6% or higher. Debt service doubles. At the same time, property values are falling. Office vacancy rates are now 20% nationally. San Francisco is approaching 30%. Austin just hit record highs. So borrowers face an impossible triangle. The loan payment doubled, the asset is worth less, and there are no buyers. What happens next? They hand the keys back to the bank. This is already underway. CMBS delinquency rates hit 6.59% in Q3 2025. Office distress reached 10.9%, up from 6.7% just 2 years ago. Regulators have identified 278 banks as vulnerable due to concentrated CRE exposure. Over 900 banks still carry commercial real estate exposure exceeding 300% of their capital. In 2008, banks loaded up on subprime mortgages. Today, they're loaded up on office buildings, retail centers, and multifamily loans. Same mechanism, different asset class. The banking system absorbed roughly $400 billion in losses during the global financial crisis. CRE losses this cycle could exceed that number. And this is only the first domino. Because once banks take losses, they do one thing immediately. They stop lending. Which brings us directly to the second fracture forming right now. A Shiller PE of 40 is not expensive. It's extreme. In 140 years, the only higher reading was 1999. What followed wasn't a pullback. The S&P fell 50%. The Nasdaq collapsed 78%. Now look at the Buffett indicator, 225%. The historical norm is 80 to 100%. Anything above 160% is danger. Warren Buffett warned that levels near 200% mean investors are playing with fire. We're well past that. And the risk is concentrated. 7 stocks now make up over 30% of the S&P 500. If they fall, the market falls. There is no diversification, only fragility. AI is real just like the internet was real in 2000. But real technology doesn't justify unlimited prices. At 40 times earnings, markets aren't pricing growth. They're pricing perfection, and perfection never lasts. Crisis 3. The debt trap. U.S. debt is now $38 trillion. We're adding about $2 trillion per year. But the real problem is interest. In 2025, the government paid $1 trillion just to service debt. More than defense. More than Medicare. Every 1% rise in rates adds $380 billion in annual interest costs. That creates a loop. More debt gives higher rates, gives higher interest, gives bigger deficits, gives more debt. And in 2026, the debt ceiling fight returns. Another downgrade is possible. In 2008, private debt broke the system. Next time, it's government debt. And when the fixer becomes the failure, options disappear. Crisis 4. The consumer breaking auto loan debt. $1.66 trillion. Average payment, $748 a month. Subprime delinquencies are at record highs. Repossessions are the worst since 2009. Credit card debt is over $1.1 trillion at 20% plus interest. Savings are gone. Credit is maxed. And this matters because car payments are the last thing people miss. When auto defaults rise, it means consumers have no margin left. Subprime is the warning system. It's already flashing red. The feedback loop CRE losses weaken banks. Banks tighten lending. The economy slows. Consumers default. Banks take more losses. At the same time, falling stocks reverse the wealth effect. Spending drops. Earnings fall. Layoffs rise. And unlike 2008, policymakers are trapped. Debt is already massive. Inflation isn't dead. Rates can't go to zero. In 2008, we had one crisis and unlimited tools. In 2026, we have 4 crises and limited responses. What you do, don't panic. Prepare. Stress test for a 30 to 40% drawdown. Hold cash. Reduce rate-sensitive exposure. Diversify outside the U.S. Own hard assets central banks already are. The mainstream expects a soft landing. History says excess gives euphoria, gives exhaustion, gives collapse. We're in late euphoria. The fuel is stacked. The system has no shock absorbers. The only question is whether you're ready when the match appears.